What if we're already in a bear market, and most investors haven't even realized it yet? Dr. Ed Yardeni, one of Wall Street's most respected voices, thinks we might have entered a bear market right after the S&P 500 hit its all-time high on February 20th. But here's the twist. He also sees this as a massive opportunity for savvy investors. Stick around, because today we're breaking down Yardeni's latest market call and what it means for your investments. Could we be experiencing another flash crash right now? Ed Yardeni suggests a bear market may have started immediately after the S&P 500 peaked on February 20th. He compares the current sell-off to historical flash crashes like those in 1962 and 1987. Sharp declines quickly followed by substantial recoveries. This rapid decline could create attractive buying opportunities, especially in previously overvalued stocks. Is policy uncertainty pushing us closer to recession? Yardeni emphasizes that the Trump administration's rapid policy shifts are stress-testing our economic resilience. President Trump recently refused to rule out a recession this year, describing our economy as a period of transition. Treasury Secretary Scott Bessent echoed this sentiment, calling it a detox period, shifting from public spending toward private sector-driven growth. Could stagflation become the next big threat? Yardeni Research recently increased its probability estimate for stagflation, a combination of weak growth and rising inflation, from 20% to 35%. The recent sharp market declines suggest investors might perceive an even higher likelihood of stagflation ahead. Growth stocks are tumbling. Should you shift your strategy? S&P 500 growth stocks have been hardest hit during this downturn, confirming market fears about recession risks. Meanwhile, value stocks have held up better, trading at forward PE valuations around 18 versus growth stocks at about 26. This divergence highlights the importance of stock selection during volatile times. Are the market's biggest winners now becoming its biggest losers? The popular Magnificent Seven, Mag 7 stocks have significantly declined, with their collective forward PE dropping from over 30 at the start of the year to around 26 today. Tesla and NVIDIA specifically have been major contributors to recent weakness in both Mag 7 stocks and the broader S&P 500 index. Investors should closely monitor these leading names for potential opportunities as valuations reset. Is the Fed coming to rescue markets? Not so fast. Despite recent volatility, Yardeni notes that Fed Chair Jerome Powell has signaled no immediate intention to lower interest rates. Powell maintains that the economy remains a good place, though he acknowledges the uncertainty surrounding current administration policies. Investors shouldn't count on a Fed put. Instead, focus on fundamentals and disciplined investing strategies. Here's why Yardeni remains bullish despite the noise. Without relying on Trump or Powell put, Yardeni advises investors to focus on underlying economic strength and corporate earnings resilience. He remains optimistic about his long-term Roaring 2020s scenario continuing throughout this decade. Notably, insider buying activity has recently surged in cyclical sectors like energy, technology, banking, industrials, and biotech, indicating that corporate insiders see real value at current prices. So what's our takeaway? Yes, markets are volatile right now. Yes, there's uncertainty around policy decisions and economic conditions. But remember, corrections create opportunities. Ed Yardeni sees these moments as ideal times to buy quality companies at attractive valuations. As disciplined investors, we should embrace corrections rather than fear them. Watch this video to hear more on the long-term investing strategy. If you found this helpful, please like this video, subscribe for more insights like this one, and let me know your thoughts below. Until next time, stay invested and stay disciplined.